One item that may come up during interviews is an LBO case study. So let's walk through an example. On the slide here, we have all of the key assumptions laid out for a scenario where WSO PE Partners is looking to acquire a target. As the first step, we need to figure out how much equity we are putting into the deal. We know that our LTM EBITDA is $100. And we are paying 7 times EV to EBITDA for the business. So we are paying $700 in enterprise value. But we also know that we're going to use 4 times leverage in our capital structure. So 4 times 100 of EBITDA gives us $400 of debt. As we learned, equity value is EV less debt plus cash. Since we have no cash, our equity is simply 700 minus 400 to give us $300 of initial equity contribution. Next, we need to figure out our debt schedule. We're told that interest on the debt is 7%. So our annual interest expense will be 7% times 400 or $28. Once we have determined our debt payments, we can figure out the rest of the cash flow components to calculate our free cash flow. Generally, for an LBO model, our cash flow will start with EBITDA. However, in order to calculate our cash taxes, we must get to EBT, or earnings before taxes. So we subtract D&A, which is given as $10, then subtract interest. Remember, our interest creates a tax shield, lowering our tax payments, and we arrive at EBT. From here, we apply a 25% tax rate, which was given to us, to determine taxes. Now we add back D&A, which is non-cash, and subtract our other 2 cash items, change in net working capital, given as -5, and CapEx, which we are told equals D&A. Summing these values, and we have arrived at our annual cash flows for the 5-year hold period. Now we must determine our exit equity. As the first step, we need to calculate our net debt. We borrowed $400 to purchase the company. However, we generated $267 of total free cash flow over the hold period, which we will subtract from our debt balance, giving us a net debt balance of $133 at exit. Then calculating our EV at exit, we use the same 7x valuation multiple times our last year or final year EBITDA. There is some rounding here, so the numbers aren't exact, but we have an exit EV of $893. Less our debt at exit, our exit equity value is $760. So now we have entry equity and exit equity. We can calculate our MOM and IRR. MOM is pretty straightforward. Just our exit equity divided by our entry equity, giving us 2.5 times our money in 5 years. Then we solve for IRR using the equation provided, and we get approximately 20%.